what's troubling the bond market is like there's a certain sense of deja vu all over again. We've got monetary policy that is no longer wants to be restrictive, wants to lower interest rates. And so I think the bond market is concerned that here we go again. If we
Yeah, that was the message coming from Dr. Ed Yardeni of Yardeni Research, the man who coined the term Bond Vigilante in the 1980s. I had the good opportunity to speak with Dr. Yardeni about why bond yields and mortgage rates in the US and Canada are rising despite the central bank cutting rates, what the new normal interest rates could look like going forward, whether or not the bond vigilantes will be making a return, and Dr. Yardeni's outlook for the U.S. economy upon the election of President Donald Trump. We will continue to track these issues on this channel. Make sure you click like and subscribe if you want to get those updates. But for now, let's get into this interview. All right, so today I'm joined by Dr. Ed Yardeni of Yardeni Research and YardeniQuickTakes.com. Dr. Ed, I want to thank you so much for being on the
My
show today.
pleasure. My pleasure.
All right, so I do want to get right into this, as you are the man that coined the term bond vigilantes.
Yep.
Can you kind of set the table for us and let us know what are the bond vigilantes?
Sure. Well, I've been doing this for a while, and we had the inflation of the 1970s. I started out at E.F. Hutton in the late 1970s. And during the 1980s, the early 1980s, there was a lot of concern that inflation might make a comeback after raging during the 1970s. And I argued that even if monetary and fiscal policy didn't do a good job of keeping a lid on inflation, the bond vigilantes would do so. And the idea was that bond yields would go up if there wasn't a credible monetary and fiscal response to inflation. So the bond vigilantes would take the law and order into their own hands, push bond yields up, and that would slow the economy down and keep a lid on inflation. And it actually worked pretty well during the 1980s. There were 3 episodes when bond yields rose, nominal GDP slowed down, inflation slowed down. But then by the 1990s, inflation continued to moderate. Maybe it was global competition from China entering the World Trade Organization. But inflation continued to moderate, and the bond vigilantes became less and less vigilant. Also, in the early 90s, the Clinton administration, Bill Clinton was told by his advisors, Robert Rubin and James Carville, that the bond, they couldn't be running large deficits because the bond market would come and take all that away from them by pushing yields up. So the Clinton administration actually managed to have quite a bit of fiscal discipline. So we really haven't seen the bond vigilantes for a while, since the 1980s. I got a call from a reporter, I think it was 2012, when bond yields rose to 40% in Greece, of all places. And the reporter asked me, did the bond vigilantes take a vacation and go off to Europe? And I said, yeah, that sure seems to be the case. But they've been more visible of late. We saw last year the bond yield in the U.S. go from 4 to 5% in just a couple of months, and just recently we've seen a rather significant increase in the bond yield. So I think they're back. I think they're kind of saddled up and ready for action if fiscal and monetary policies remain excessive and increase the likelihood of a rebounded inflation.
Yeah, we've seen the yield on the 10-year. It's up about 70 basis points over the past
Right.
couple of months. And you said it could go back to
It
5%.
could, yeah. Yeah, I
Uh,
mean, yeah, the interesting thing is the Fed lowered the Fed funds rates in September 18th by 75 basis points, and the bond vigilantes, I think, are making themselves not heard by going the other way, as you said, 70 basis points. So at least offsetting what the Fed has done, and long-term rates matter a lot more than short-term rates to a lot of borrowers.
Long-term rates set mortgage rates.
Yeah.
Yeah. And so what is it that you think the vigilantes are having the difficulty with? Is it the fiscal
Yeah.
side of the equation? Is it inflation? Where's
Well,
the issue here?
Well, in 2020, 21, the Fed was focused on bringing the unemployment rate down. They felt quite comfortable that inflation wasn't a problem, and it wasn't at the time. But they said of their dual mandate, their number one priority was to to bring the unemployment rate down, and they succeeded in doing that. But they failed to recognize that by stimulating to such an extent by lowering interest rates, and you remember the bond yield got down to 0.5%. The Fed funds rate was zero. And as a result of that, combined with lots of fiscal stimulus, remember the three checks that were deposited in millions of Americans' checking accounts was stimulative. And then the Biden administration had a couple of big spending bills. So fiscal policy has been very stimulative, and that brought inflation back quite dramatically in 2022 and 2023. Some of that was pandemic related, but certainly some of that was related to too much stimulus by the fiscal and monetary sides. So then the Fed turned around, pivoted pretty rapidly in 2022 and started raising rates from 0 to 5.25%, 5.5%. And that contributed to bringing inflation down, but some of the pandemic shocks wore off and inflation came down. What's troubling the bond market is like there's a certain sense of deja vu all over again, in that the fiscal stimulus is still strong, even before the Trump administration comes in. And with the Trump 2.0 promising more tax cuts and maybe more government spending, though they are talking about finding ways to cut it. But the market has to be concerned about fiscal stimulus remaining excessive. And at the same time, we've got monetary policy that is no longer wants to be restrictive, wants to lower interest rates. And so I think the bond market is concerned that here we go again. If we have too much fiscal and monetary stimulus, the way we had in 2021, leading to the inflation surge of 2022, 2023, we'll have that all over again. So that's where the concern is. And that's why I think the Bond Vigilantes basically voted before November 5th. They started voting, I think, on September 16th, when the 10-year got down to 3.65%. And here we are at 4.40%.
So we've got fiscal loosening with Trump coming into office. We've got some apparent monetary loosening. The Fed's
Correct.
now dropped by 75 basis points.
Right.
All coming right after all these bond investors really got burned over the past few years.
Yeah, very volatile.
So twice burned, once shied, or whatever the saying is.
Yeah. But I think it is an increasing concern about the debt problem. I've been doing this for over 40 years, and for over 40 years, people have been warning that a debt crisis is coming, and that things would blow up as a result, and it hasn't happened. And I've been saying that I'll worry about the debt problem when the bond market worries about it. And the bond market over the past few decades has learned that the biggest deficits occur during recessions, when the Fed's lowering interest rates and inflation's coming down. So don't worry, be happy. Buy the bonds, and sure enough, if you buy them going into a recession, the yields go down, not up. But things changed with the pandemic, and in recent years, especially with the Biden administration, we had quite a bit of deficit widening in an environment where the economy was growing. The economy wasn't in a recession. There was lots of scares about going into recession, but practically speaking, the economy was still growing, and yet we were running these large deficits. And so that became an increasing concern, and people like Ray Dalio have been warning that it was imminent. Particularly last year, I think Dalio was quite concerned. And sure enough, August, September, October of last year, the bond yield did in fact zoom up from 4% to 5% in just a few months. On November 1st, we, just about when we were around 5%, Janet Yellen of the Treasury Department basically told the Bond Vigilantes, well, if you don't like my bonds, I'll just do more in bills. And that's what she did. And the inflation news continued to improve. And so 5% turned out to be a great buying opportunity. We may have another opportunity around 5% if the Bond Vigilantes get upset about the outlook for debt. And if we have some concerns that inflation might be rebounding. Those are the risks. They're not kind of where my head's at. I'm really thinking that the economy continues to grow, that productivity is making a comeback, that keeps inflation down. So I'm really thinking that the bond yield really is back to normal. We're thinking, and let's I mean, my ranges change. I have to be honest about that, but 4 to 5% is a pretty wide range, of course. But I think that's kind of the range we were at before the great financial crisis. So I think we've kind of normalized. Right now, my range is more like 4.25 to 4.75% on the bond. So I'd be a buyer at 4.75%. I don't know if I'd get greedy and wait for 5%, but again, it's possible.
So, and I want to follow up on that
Sure.
because, well, here in Canada, as we're learning, because our central banks dropped rates by 125 basis points, and we're seeing our fixed rates move upwards. So we're
Yeah.
obviously learning that lesson that it's fixed rates that run the show.
Right.
So, but you think that 4 to 5% is probably about that's normal. That's what we
That's
should kind of
normal.
expect going
Yeah.
forward.
Yeah, I think
Okay.
the real abnormality was what happened to rates and with quantitative easing in the United States and other central banks as well overseas, where the short-term central bank rate was zero, some cases slightly negative. We had negative bond yields overseas, zero bond yields in the U.S., and that was the abnormality. That's one of the reasons I did not think we were going to go into a recession when the Fed tightened because, yeah, they went from 0 to 5.25%, but 5.25 was not the abnormality. It was zero that was abnormality. So I think there certainly was some tightening, but there also was quite a bit of normalization. So I think it's a sign of a healthy economy to where you have bond yields that are kind of where they are now. And I'm not convinced that the Fed really should have or should continue to lower short-term interest rates. The so-called neutral rate is a fantasy rate, anyways, and it can't be. Everybody agrees that it can't be measured, and that it probably changes. So what's the point of even thinking about it? But Fed officials have declared that the Fed funds rate at 4.75% is still too restrictive and above neutral, like they know what neutral is. But I'm looking at the economy and said, well, if there is such a thing as a neutral rate, we're there.
Well, let me ask you while we're talking about the Fed trying to get to neutral, if bond traders are keeping fixed rates high, if they're keeping yields high, but the Fed wants to loosen, is it going to try to, do you think it'll try to counteract the long end by going lower on the short end?
Maybe that's what they have in mind here is, I mean, they had to be blown away by the reaction of the bond market. I'm sure they were expecting that they lowered, significantly by 50 basis points on September 18th. And then last week they lowered it by another 25. And so I'm pretty sure that they were kind of shocked to see the bond yield go up. But maybe I'm not so sure because then I listened to Fed Chair Jerome Powell's press conference last week, and he was asked a couple of times, "Aren't you concerned about the backup in bond yields? What's that telling you?" And he kind of blew it off, and he said, "Not much. Bond market's volatile." He pointed out it went up to 5%, and then it came down, so he's not really reading much into it. But I thought that was remarkably blasé about the message being sent by the bond market. So yeah, it may be that the Fed just thinks that what's important is to lower the Fed funds rate, and everything else will adjust to it. But I think that clearly the idea of bond vigilantes is not something that's driving monetary policy the way it drove fiscal policy when Clinton was president.
Yeah, what was Carville? What did Carville say? If he could be anyone, he'd want to come back as a bond vigilante because you can
He didn't say
intimidate
bond
anyone.
vigilante, but
No,
he wanted to come back as the bond market because
the
it's
bond
so
market.
all powerful. I don't remember the exact quote. He didn't use the expression bond vigilante, but if for all practical purposes, that's what he was talking about.
That was it, right? Um, so I do want to talk to you about the elephant in the room, the
Sure.
election of President Trump. You wrote in a few days ago, maybe a week ago, that there's three possible outcomes that you saw. There's a 50% chance of a stock melt up. I think it was 20%. No,
Yeah,
50% of the roaring 2020s. I'll let you say it.
let me do it for you because I get
You do it.
confused sometimes. So yeah, kind of using decade analogies. the 2020s rhymes with the 1920s, and we've been thinking that with the technological innovations out there, we may and labor shortage, we may very well have a productivity-led economic boom with low inflation, and call that the roaring 2020s. And before the election, we were using 50% as a subjective probability. After the elections, we raised that to 55%. We think it's more likely now with the animal spirits unleashed by Trump at 2.0. And of course, Trump has a clean sweep. So I think for the next 2 years, or maybe the next 100 days, the Republicans are going to move fast to change things pretty radically in a way that I think supports the idea of a stronger economy, more productivity, and so on. The second scenario of the three would be a comparison to the 1990s, particularly late 1990s, where we had a melt up. And so we were using 20% subjective probability for that. We raised that to 25%. And the idea there being that with lots of fiscal stimulus, with the Fed now easing more than maybe overstimulating a hot economy, that we'll see that in a melt up in the stock market. And we're basically kind of in the early phases of a melt up. I mean, the valuation multiples aren't cheap, they're stretched. Last week, we saw the market surge from a forward PE of 21 to 22. So we're already sort of seeing aspects of a melt up. And so that adds up to 25 plus 55 gives us 80% likelihood that we are in a bull market, that the economy continues to grow, that things go pretty well. And if anything goes wrong, it'll be a melt up that might be followed by a meltdown, but it doesn't have to be a bear market. It could be a correction, and life goes on, and things will work out for the market with a target of something like 8,000 to maybe 10,000 on the S&P 500 by the end of the decade. Then the third scenario is kind of the bucket for everything that could possibly go wrong. And we had 30% in there. And after the elections, we made that 20% because it included geopolitical risk. And I think the markets, and we kind of agree with it, that with Trump, the geopolitical risk might be reduced. Trump might succeed in bringing an end to the conflicts between Ukraine and Russia sooner rather than later, in the Middle East sooner than later. Not to say that things couldn't possibly flare up again, particularly in the Middle East. But I think that our assessment and the market's assessment seems to be geopolitical risk could be reduced. The debt crisis is also in that bucket. And we're thinking that Trump has managed to buy us some time before a debt crisis occurs, if it's going to occur, by appointing Vivek and Elon to run DOGE, the Department of Government Efficiency. And Trump is a bit of Elon Musk is a bit of a bullshit artist, and he was asked how much he thought he could cut from government spending. He said $2 trillion, and he has a tendency to overpromise and not to deliver on time. But on the other hand, I read his biography by Walter Isaacson called Elon Musk. It's a must-read for anyone in this business. And he's a real good cost cutter. But it's one thing to cut costs at a company that you own and run, and fire people who don't work with you to do that, and try to do that in the government. But between deregulation and the attempts to cut government spending, we may very well see that the deficit issue is sort of on the back burner for a while. And by the way, if we get better than expected growth, which I think we could, I think next year could be a real strong growth with productivity continuing to make a comeback. If all that comes into place, the debt to GDP ratio may go up at a slower pace, and so that's kind of in that bucket as well. So anything that could go wrong goes into that 20% bucket, and it's subjective probabilities. And I've shown that this flexibility. I'm willing to change the probabilities if circumstances change. And I think the elections, as you see, didn't radically change our views. We were in the roaring 2020s camp before Trump was elected. Our view has been, it's amazing how well the U.S. economy does despite Washington. So I was ready for a Harris administration and still had an optimistic view of what the economy would deliver.
It does seem like a tall order on Elon Musk's plate. They've got, or even on the
Yes,
president's plate, they have to cut all that spending while keep the economy running hot. I'm not
right.
sure how you get rid of that many government jobs,
Yeah,
and the economy doesn't feel at least it's something immediate protraction.
yeah. Well, I think much is going to depend on how fast they do things. If they do things too fast, that could be very destabilizing to the economy. I mean, for example, mass deportation. The fact of the matter is, previous administrations also had mass deportations. Just we're talking about 2, 3 million people per year were deported. I think it was per year. It might be per term. I don't recall exactly, but it's not as though deportation isn't what the government has done before to people who weren't legally here. So if it's done too radically, obviously it could upset the economy. But even the new borders are said that the focus will be on the bad actors, the people that they know are criminals and possibly terrorists, and to get them out of here. I think if you just kind of put everybody in a bus in one day, I think there'd be a lot of political backlash just from companies that say, we know we're not supposed to be hiring illegals, but wink, wink, we did that anyways, and it could be really, really disruptive to our business. So I think that's going to occur over the next few years. It's not going to be an overnight situation, and it may very well be the same thing with the government. But I think there'll be a lot of attempts to demonstrate that things have changed by firing people. RFK wants to fire some people from one of the health organizations administrations. But yeah, there's a lot of known unknowns. We know these things can be disruptive. On the other hand, if a lot of these if a lot of these things are done right, they could make for a healthier economy and society.
It's very early days on
Very
what
early.
looks like is going to be a pretty big shakeup
Yeah, I think
from what
so.
we're accustomed to. Yeah.
Yeah, I think what's different between Trump 1.0 and Trump 2.0 is Trump said it himself. He was like, he didn't know anything about Washington. He was kind of naive. And, the dumbest thing he did starting in Trump 1.0 was in his inaugural address, tell the deep state that he's going to come after them. So that gave him plenty of notice that they had to come after him. And they did big time during the first term. But now he's got a clean sweep, and now he's putting in people that he knows and are loyal to him. They're not going to quit after 6 months and write a book. At least I don't think so. And they know his style, and they know that there's a lot about his personalities that not everybody likes. But at the end of the day, it's all about the policies, and they're all on the same page, and that seems to be what we have.
You can tell he knows what he's doing this time. He's not tweeting about rallies. He's like
Yeah,
on it from jump.
yeah, he may. I wouldn't underestimate the possibility that he's matured, grown up. He was kind of a fifth grade bully boy during the first term, and maybe he's going to be more focused on getting things done. Maybe he doesn't have to be the bully boy anymore because he's kind of got the kind of power he needs to change things. It's conceivable that getting shot at and having his ear nicked made him realize that he's not here for much longer, and he wants to actually accomplish things, not just kind of you know be a bully that doesn't get much accomplished. So I think he may have changed, but who knows?
Should be an interesting few years to say the least.
Yeah.
Okay.
Well, I think it'll be interesting 100 days and then
Yeah.
2 years, and then we'll see what the midterms are. I think they know that there's a good chance they're going to lose their sweep in the midterms if they really screw things up and get too controversial. But the country definitely shifted in Trump's direction, or at least they've shifted away from the left orientation of the potential Harris administration.
By a large amount, that's for sure.
by a
Yeah.
large amount, and that's
Yeah.
that's significant. I
Yeah.
think that gives him a lot of flexibility in what he does.
Yeah. All right, Dr. Ed, I want to thank you so much for being on the show today.
Sure.
The website is YardeniQuickTakes.com.
Yep. You
Yep,
got it.
I will have a link in the description. Everyone, please do take a look. And thank you so much again.
Thank you. All the best.
Bye now.
Bye bye.